Welcome to the finance lecture. What if the hardest part of automating a legacy insurer is not teaching the machine to read the file, but discovering that the file was never the system? That is the part almost nobody says out loud. They say the problem is data quality. They say the problem is old software. They say the problem is that the policy administration system does not talk cleanly to the claims platform. All of that is true. None of it is deep enough. The insurer is not one system. It is a treaty between systems that do not fully trust each other. A quote screen holds one version of the risk. A policy form holds another. A broker email contains the part nobody wanted to standardize. A claim note contains the operational memory. A vendor list contains the field intelligence. A state endorsement contains the legal override. A reinsurer may hold the real binding constraint. Stay with me because this matters. When people talk about artificial intelligence in insurance, they usually imagine a model reading documents faster than a human adjuster or underwriter. It extracts fields, it summarizes loss facts, it drafts emails, it flags subrogation, it routes the claim. That is useful. It is not transformation. It is clerical acceleration on top of an unmodeled institution. The attached workflows make the problem visible in miniature. New business enters at EAS. A duplicate submission check happens. Submission review may require missing information from an agent, reports such as D&B, a referral if authority is exceeded, a facultative reinsurance quote if the risk needs outside capacity, quote proposal creation in Advantage, and then documentation back into at EAS. The machine did not make one decision. The institution made a sequence of authority transfers. Now, look at the small detail that seems harmless. Details from the POF pull into Advantage. Some fields in the quote screen are grayed out. If those details are wrong, the user must change them in the POF and refresh the quote. That is not a user interface quirk. That is a statement about source of truth hierarchy. The rating screen is not sovereign. The policy order form is upstream. This is where most consultants misread the place. A systems integrator sees duplicate entry. A business analyst sees workflow friction. A data scientist sees a feature table. A senior underwriter sees something else. He sees the embedded constitution of the business. Who is allowed to change what? Which screen has legal authority? Which mistake can be corrected by endorsement? Which mistake creates a coverage dispute? Which mistake is merely annoying? Artificial intelligence does not understand any of that unless it is explicitly modeled. I learned this lesson years ago in a different context, not insurance, but fixed income. At Salomon, as a young analyst, I watched people treat mortgage bonds as instruments that could be described by cash flow tables. They were not wrong. They were also not seeing the institution. The security was a cash flow table, yes, but it was also a servicing convention, a prepayment model, a dealer inventory constraint, a rating agency grammar, a repo financing object, and a legal document. The table was only the surface. Insurance is worse. In fixed income, most of the market at least agrees that the cash flow is the thing to price. In specialty insurance, the cash flow is what happens after language, jurisdiction, behavior, weather, vendor capacity, broker communication, and file documentation collide. The claim is not merely a loss. It is a staged interpretation of whether a reported event fits a contract, whether the insured preserved rights, whether a surveyor can determine cause, whether a deductible applies, whether depreciation applies, whether subrogation survived, whether a proof of loss must be notarized, and whether payment can move through a controlled channel. So what does that actually mean? It means the frontier is not model size. The frontier is institutional representation. OpenAI, Claude, DeepSeek, and the next model after them can all read better than last year's model. That improvement helps. It does not solve the core problem. The core problem is that a legacy insurer's most valuable knowledge is not stored as text. It is stored as permission, sequence, exception, habit, and fear. Fear is not a rhetorical word here, it is operational. An underwriter fears binding outside authority. A claims adjuster fears waiving a coverage defense. A compliance officer fears unfair discrimination. A broker manager fears damaging distribution. A reinsurer fears adverse selection hidden inside a bordereau. A regulator fears proxy variables. A chief information security officer fears insured data leaving controlled environments. A vendor manager fears a marine surveyor, body shop, restoration contractor, or attorney becoming an uncontrolled extension of the carrier. Those fears are not irrational. They are the control system. And that is why the seductive version of insurance AI is dangerous in a very specific way. It promises to remove friction. Yet in insurance, some friction is waste and some friction is governance. A late email is waste. A second review on an over-authority submission is governance. Manual reinsurance certificate capture is waste when it is just typing. It is governance when it prevents coverage from being bound without capacity. The hard question is not whether the task can be automated. The hard question is whether the task is a delay or a break. A break is not inefficiency. A break is how the institution stays alive. This lecture is about that distinction. The The insurer that understands it will not merely deploy artificial intelligence. It will build a decision layer over the business. The insurer that misses it will spend tens of millions of dollars teaching a model to summarize files that the organization itself does not fully understand. And the cruel part is this. The first demo will look excellent. The model will read the policy. It will draft the acknowledgement email. It will identify the deductible. It will summarize the facts of loss. It will even suggest subrogation potential. Everyone in the conference room will nod. The vice president will ask how fast it can be scaled. The consultant will say the limiting factor is data access. No. The limiting factor is whether the organization can say, with precision, what the model is allowed to know, what it is allowed to infer, what it is allowed to recommend, what it is allowed to write back, what human role must approve the action, what evidence must be preserved, what policy language controls the decision, what state law modifies it, what broker expectation constrains the communication, and what audit trail will survive the next market conduct exam. That is the machine. Everything else is a screen. Let us start with the simple version and then destroy it. The simple version says, legacy insurers have old systems. Old systems store data poorly. Artificial intelligence can read unstructured files, translate old code, generate documentation, and create a conversational layer across the business. Therefore, artificial intelligence can modernize the insurer without the painful replacement of core systems. That story is not false. It is just the kind of truth that burns capital. A legacy insurance carrier is not old in the same way a retailer is old. A retailer may have product catalogs, inventory systems, customer records, pricing tools, fulfillment systems, and returns. Those are hard. Insurance adds something more difficult. The product is a promise whose meaning may not be known until after a loss. The administrative system does not merely store the product. It stores evidence of what the promise was believed to mean when it was sold, endorsed, billed, renewed, and claimed against. That is why old insurance systems are so resistant to clean abstraction. In the attached training path, Advantage is described as the system where quotes are created, policies are issued, and policy change transactions are processed. That sounds like a core operating platform. Then the same material says the Quote tab uses the POF number to pull details from an EAS, and some fields must be changed inside the POF rather than in Advantage. In one sentence, the architecture announces the central problem. The business event lives across systems, and the authority to change the event is not identical to the place where the user sees it. This is not merely integration debt, it is semantic debt. Semantic debt means the same object does not mean the same thing in every system. A vessel in a quote may be a rating exposure. A vessel in a claim may be damaged property. A vessel in a policy form may be insured property, subject to navigation limits and exclusions. A vessel in a surveyor report may be a physical asset with cause of loss evidence. A vessel in reinsurance may be an accumulation exposure. A vessel in a broker email may be a relationship-sensitive renewal. Same noun, different institution. Palantir's ontology languages is useful here, not because every insurer needs Palantir, but because it names the missing layer. The problem is not only data integration, it is representing the business as objects, links, actions, functions, permissions, and writebacks. In insurance terms, the ontology is not customer, policy, claim. That is too shallow. The real ontology is policy, promise, underwriting authority, broker channel, exposure object, jurisdictional modifier, endorsement action, claim theory, coverage position, payment authority, vendor evidence, recovery right, and audit obligation. Right. Now place a language model on top of the shallow ontology. It will behave intelligently while acting on a false map. It may see a claim involving a submerged vessel and summarize the loss. It may extract the date, location, known damages, and repair facility. It may identify that a surveyor is needed. Good. But the actual decision depends on the cause of water entry, the exclusion language, the resulting damage, carve-back, maintenance condition, prompt notice, whether the insured preserved inspection rights, whether the vessel was within navigation limits, whether a layup warranty applied, whether salvage was voluntary or necessary, and whether a third party impaired subrogation. A model can read those words. Reading is not governing. The hidden challenge is that each insurance function holds a different failure definition. For underwriting, failure may be underpriced risk. For claims, failure may be paying uncovered loss or mishandling covered loss. For actuarial, failure may be distorted loss, data feeding future rates. For legal, failure may be waiver, estoppel, bad faith, privacy breach, sanctions violation, or discriminatory use of data. For brokers, failure may be a technically correct answer delivered in a commercially destructive way. For reinsurers, failure may be ceded risk that does not match the assumed treaty logic. The company calls all of this insurance. Artificial intelligence sees a pile of documents. That is the first great collision. The second collision is headcount. AI business cases often sell labor substitution, fewer adjusters, fewer underwriters, fewer assistants, faster file setup, faster correspondence, faster review. Yet, in a legacy insurer, experienced employees are not just labor. They are undocumented middleware. They remember that a certain class of marine loss always requires a surveyor. They know which broker sends incomplete submissions. They know that a certain endorsement prints automatically, except when a manual form was added. They know that a particular state requires a different cancellation notice rhythm. They know the reinsurer will ask for a certificate before bind, replaced too quickly and the system loses its memory. This is the secret HR cost of AI transformation. The same employee whose task looks automatable may be the only living link between the formal workflow and the real exception tree. If that person leaves before the exception tree is captured, the carrier has not automated the process. It has deleted the process and kept the screen. Consultants underestimate this because the knowledge is often invisible during discovery. When you ask employees to describe the workflow, they describe the official workflow. When you watch them work, you see the institution. They pause before sending an email, they check a folder that is not in the procedure, they ask a colleague whether this producer needs special handling, they copy language from a prior file, they avoid a field because changing it triggers downstream print behavior. They save a document into an EAS because they know the next auditor will not trust a local file. None of that appears in the clean process map. This is why Claude Code, OpenAI agents, and DeepSeek-style reasoning models matter, but not in the way the sales deck says. The most valuable early use is not autonomous decisioning. It is institutional archaeology. Let the model compare training paths, workflows, policy forms, claim templates, vendor spreadsheets, email samples, authority charts, reinsurance procedures, and state rules. Ask it to surface contradictions. Ask it to find where the same concept appears under different names. Ask it to identify steps that are required by law, steps required by system architecture, steps required by reinsurance, steps required by habit, and steps that nobody can justify. That is where the money is, not in replacing the adjuster on day one, in discovering what the adjuster is actually doing. There is a history here that insurance executives rarely tell in public, because it makes the modernization problem look less like technology delay and more like accumulated institutional compromise. Specialty insurers grew through product expertise, acquisitions, regional books, delegated authority, broker relationships, and idiosyncratic systems. That is not a criticism, it is how the business was built. Ocean marine, inland marine, surety, management liability, environmental, excess property, entertainment, technology, accident and health, and tuition refund are not merely product names. They are small legal civilizations with different evidence standards, vendor networks, pricing habits, and claim rhythms. A personal auto carrier can standardize far more aggressively. Specialty insurance punishes excessive standardization. An ocean marine hull file has facts that do not look like a commercial general liability file. A vessel schedule matters, navigation area matters. Crew, pollution, protection and indemnity, loss of hire, mortgagee interests, increased value, additional insureds, and lost pays can matter. The attached training path even notes that vessel details can be entered directly or imported through a spreadsheet, and that the Excel copy may become part of underwriting rating documentation. That small detail says something large. The spreadsheet is not just a convenience, it can become evidence of how the risk was understood. Legacy systems are full of these artifacts. A form library is not just forms, it is the policy grammar. A renewal workflow is not just timing, it is the moment when pricing, aggregation, reinsurance, loss runs, broker information, and expiring terms must be reconciled. A vendor list is not just contacts. It is a distributed claims infrastructure, state by state, specialty by specialty. A claim template is not just correspondence. It is a legal posture in prose. This is why the one beacon to intact transition matters as a pattern. Publicly, the rebrand notice says One Beacon Insurance Group became Intact Insurance Specialty Solutions, and that the change did not alter policies in force. Operationally, a rebrand like that leaves behind layers. Old policy forms, old names, old producer expectations, old subsidiaries, old workflows, old claim templates, old system labels, and new enterprise strategy. The policyholder sees continuity. The AI model sees naming noise. The institution sees both. Now add the contemporary pressure. Intact publicly tells investors that data and AI are central to pricing, risk selection, and operations. That is not window dressing. Intact has the scale to build serious internal capability. The annual report describes hundreds of specialists and hundreds of models. This creates a subtle split inside the enterprise. The Canadian personal and commercial lines AI machine may be mature in pricing and risk selection. The United States specialty lines transformation problem may be structurally harder because the objects are messier, the products are thinner in volume, the policy forms are more varied, and the claims evidence is less standardized. 1 million auto claims train one kind of machine, a few thousand complex marine files train another. This is where DeepSeek enters the story, but not as a magic answer. DeepSeek changed the psychological price of reasoning. When an open weight reasoning model appears with strong math, code, and reasoning performance, every chief information officer has to ask whether some tasks should move away from expensive closed systems toward controlled, lower-cost internal deployments. That question is rational. For an insurer, it is also incomplete. The model cost is not the system cost. To run sensitive insurance workflows with open weights, the carrier still needs controlled infrastructure, access management, logging, encryption, prompt and response retention, model evaluation, hallucination testing, privacy review, incident response, adversarial testing, red team files, vendor risk classification, and a way to prevent local convenience from becoming shadow automation. A cheap reasoning model can become expensive governance very quickly. Closed systems have the opposite problem. OpenAI's business offerings say business inputs and outputs are not used for training by default. Anthropic's Claude models and Claude Code are built for coding, long-running agent workflows, and local file collaboration. Those are real advantages. Yet the carrier still has to decide which files can enter the model context, which outputs become records, which prompts expose insured data, which responses create discoverable material, and which agent actions count as claim handling. The model vendor may not train on the data. The insurer still used the model. That distinction will matter in litigation. Insurance is a record-keeping business wearing a risk transfer costume. Every action leaves a residue. A claim note, a diary, an email, a policy endorsement, a premium registration, a proof of loss, a surveyor assignment, a vendor invoice, a reinsurance certificate, a denial letter, a reservation of rights. If an AI system drafts, ranks, recommends, or silently shapes any of these, the carrier must be able to explain the role of the system. The regulator will not ask whether the demo was impressive. The regulator will ask who approved the use case, what data was used, what bias testing was performed, what third-party system was relied upon, what documentation exists, what monitoring was done, and what consumer harm could have resulted. That is the history nobody tells. Insurance did not fail to modernize because executives lacked ambition. It failed because the business spent decades embedding legal judgment into operational sediment. Every year added a new layer, new state rule, new endorsement, new vendor, new broker expectation, new reinsurance condition, new platform, new acquisition, new exception. Artificial intelligence does not remove sediment, it excavates it. An excavation is dangerous when the building is still occupied. The surface mechanism is system fragmentation. It is real, measurable, and expensive. There is at EAS, there is at Vantage. There are quote folders, issue folders, policy change folders, forms tabs, premium tabs, producer tabs, record tabs, renewal filters, status lists, endorsement POF types, and background tasks. There are policy forms in PDF. There are claim templates in Word. There are vendor lists in spreadsheets. There are broker emails. There are reinsurance systems. There are probably imaging tools, payment systems, reporting cubes, finance feeds, data warehouses, help desk tickets, and local files that never make it into the official diagram. This is the layer Infosys can see. It can inventory applications. It can document data flows. It can translate stored procedures. It can expose APIs. It can create a conversational layer. It can build extraction pipelines. It can migrate policy data. It can reduce duplicate entry. It can summarize knowledge bases. It can help developers refactor code faster. It can build test cases. Those are valid contributions, but the surface layer has a trap. It makes every problem look like movement of information. In insurance, the harder problem is movement of authority. Take a policy change. A system can detect that an insured name changed, but who is authorized to change it? Does the change affect additional insureds, lost payees, endorsements, notices, billing, producer records, sanction screening, or policy print? Does it require a name and address change, POF? Does the change alter the legal entity in a way that should trigger underwriting review? Is it merely a typo or a transfer of interest? Those are not the same event. Take a renewal. The workflow may begin automatically, 95 to 105 days before expiration, depending on business unit. That looks automatable. Yet the same workflow may require pricing change calculation, pull forward documentation, broker of record change, survey date entry, event flags, and the ability to stop or resume automated renewal. Automation exists already. The problem is not whether renewal can be automated. The problem is when it must be interrupted. Take a claim. The template may request date of loss, reported date, assignment date, facts of loss, known damages, recovery, statement of loss, surveyor report, repair estimate, deductible, depreciation, and payment path. A model can extract all of that, but it must also know what evidence is missing. It must know when cause of loss is unknown. It must know when machinery damage or submersion requires a surveyor because coverage turns on cause. It must know when proof of loss must be notarized because the amount crosses a threshold. It must know when subrogation is alive, when it has been impaired, and when a third-party claimant changes the file. This is not a summarization problem, it is a control problem. The surface architecture creates several failure modes. First, stale truth. At Vantage may display data pulled from at EAS, but if the POF is wrong, the quote can become downstream wrong with a clean-looking screen. AI trained on the screen will trust the wrong layer unless it understands source hierarchy. Second, form drift. Forms may be systematically added based on selected quote options, but users can upload PDFs, amend skeleton forms, exclude forms from endorsement print, or add wording. A model that treats form presence as deterministic will miss the manual overrides that create real coverage exposure. Third, jurisdictional branching. Massachusetts auto procedures, California cancellation rules, New York AI guidance, Colorado external data restrictions, maritime law, policy arbitration clauses, and state conformity clauses all alter the shape of the same nominal workflow. The model cannot merely know insurance, it must know where the insurance is operating. Fourth, vendor opacity. A claim decision may rely on a marine surveyor, repair yard, attorney, recovery vendor, restoration company, or appraiser. The carrier does not fully control those actors, yet their evidence enters the claim file. AI that treats vendor output as clean data imports outside error into inside authority. Fifth, broker channel tension. Brokers are not just intermediaries, they are distribution assets. A technically efficient AI workflow that degrades broker confidence can destroy profitable flow. The model can draft fast. It cannot know relationship temperature unless the carrier represents that relationship as a managed object. Sixth, actuarial contamination. Claims automation can change loss development, faster closure, different reserve timing, altered payment patterns, and modified subrogation referrals can distort historical triangles. Actuaries may think they are observing risk. They may be observing a process change. This last point is underappreciated. When AI changes claims handling, it changes the data future models will learn from. If low-severity claims are closed faster and high-complexity claims receive deeper review, the loss history shifts. If subrogation referrals increase because a model sees more potential recovery, gross and net paid patterns shift. If depreciation is applied more consistently, severity shifts. If proof of loss delays shorten, payment timing shifts. The model becomes part of the actuarial environment. So the first mechanism is fragmentation, but not just software fragmentation. It is fragmented truth, authority, timing, evidence, and accountability. A consultant can integrate the screens and still fail to integrate the business. The hidden wiring is this: insurance decisions are not made inside systems. They are made at the boundary between contract language, regulatory permission, capital appetite, broker distribution, and operational evidence. That boundary is where AI transformation either becomes powerful or becomes theater. The naive AI roadmap says, start with document ingestion, then summarization, then workflow routing, then recommendation, then decision automation. The serious roadmap says something different. First, classify every use case by authority. Is the system reading, drafting, recommending, deciding, binding, paying, denying, repricing, non-renewing, flagging fraud, changing commission, altering reserves, or writing to the system of record? Each verb has a different risk. Reading is not drafting. Drafting is not recommending. Recommending is not deciding. Deciding is not binding. Binding is not paying. Paying is not denying. Denying is not non-renewing. This sounds pedantic until the regulator arrives. An AI assistant that summarizes a file may create little consumer harm if the human ignores it. An AI tool that recommends claim denial touches coverage. An AI tool that predicts fraud touches fairness and investigation. An AI pricing model touches protected class proxy risk. An AI underwriting triage model touches access to insurance. An AI broker prioritization model touches distribution incentives. An AI reserve model touches financial reporting. Same technology, different legal organism. That is why NAIC's AI framework is not just compliance paperwork. It is a map of the control problem. Governance, risk management, internal audit, life cycle monitoring, third-party systems, claims, fraud detection, underwriting, rating, pricing, and consumer impact all have to be represented. New York's guidance goes further by forcing insurers to own the vendor problem. You cannot say the model belonged to the vendor. If the model shaped underwriting or pricing, the insurer remains responsible. Now consider what this does to a company like Intact Specialty. The public parent has scale, capital, data scientists, actuaries, and model inventory. The specialty unit has complex products, lower frequency risks, broker-driven distribution, policy form variation, and file evidence that may not be cleanly structured. The group may be advanced in AI while a specific specialty workflow remains hard to automate. Both can be true. This is the hidden asymmetry. A carrier with mature personal lines AI may overestimate how portable its playbook is. Personal lines has volume, specialty has sparsity. Personal lines has tighter product standardization, specialty has manuscript language, endorsements, facultative reinsurance, and broker negotiation. Personal lines can model many outcomes from many records. Specialty often has to reason from fewer cases, richer documents, and higher consequence per mistake. The data problem is not small data, it is high-meaning data. A single marine claim file may contain more institutional signal than 1,000 simple auto glass claims, but the signal is buried across policy language, claim chronology, surveyor findings, photos, repair estimates, emails, subrogation notes, depreciation calculations, and payment controls. The model must not merely extract facts, it must preserve the chain of reasoning. This is where an ontology approach becomes the real battlefield, not a generic knowledge graph. A carrier-specific operational ontology with verbs, objects, insured, producer, policy, coverage part, vessel, location, navigation warranty, endorsement, claim, occurrence, cause of loss theory, surveyor, repair estimate, deductible, depreciation category, proof of loss, reinsurer, recovery target, attorney, payment, regulator, state rule, links, policy covers vessel, claim arises from occurrence, occurrence occurred within or outside navigation limits, surveyor inspected vessel, estimate supports damage scope, endorsement modifies coverage, payment consumes deductible, recovery target may owe contribution, reinsurer attaches to layer, broker controls, distribution relationship, actions, request missing information, refer over authority, assign surveyor, issue reservation, approve estimate, apply depreciation, request proof of loss, escalate to SIU, notify reinsurer, bind quote, issue endorsement, stop automated renewal, resume renewal, change billing plan, exclude form, send electronic policy delivery. Permissions, who can view, who can edit, who can approve, who can override, who can bind, who can pay, who can deny, who can disclose, who can export. That is the AI transformation. Not a chatbot, not a co-pilot, a governed representation of the institution. Once that exists, the model becomes powerful because it is no longer floating over documents. It is acting inside a controlled grammar. It can say, this claim looks like a submersion file with unknown cause, surveyor required before coverage position, possible wear and tear exclusion, but resulting sinking carveback may matter, statement of loss pending, repair estimate not yet validated, deductible unresolved, payment not authorized, subrogation unknown, no denial language should be drafted yet. That is useful. That is not magic, it is structured judgment. The hardware question fits here too. HP AI PCs, Copilot plus PCs, neural processing units, local inference, secure file analysis, and edge processing sound like procurement trivia until you understand the data boundary. For a claim handler reviewing sensitive insured documents, local AI may reduce cloud exposure. For enterprise model governance, local AI may increase uncontrolled variation. If every laptop can run a model, every laptop can become a shadow claim system. The computer is not neutral. A locked-down cloud workflow may be safer than uncontrolled local reasoning. A local model may be safer than sending documents to an external service. The answer depends on logging, retention, access control, endpoint management, model versioning, and whether outputs become part of the claim record. Device strategy is not IT housekeeping. It is insurance governance at the edge. The final hidden challenge is incentive design. If AI productivity metrics reward closed files, adjusters will close files. If they reward lower severity, coverage disputes may rise. If they reward faster underwriting response, underwriters may accept worse submissions. If they reward model adoption, employees will paste sensitive data into tools. If they reward headcount reduction, managers will eliminate the people who understand exceptions. If they reward automation rate, the carrier will automate the easy cases and leave the complex cases more concentrated, making remaining human work harder and morale worse. AI does not just perform tasks, it changes the payoff matrix. The company that wins will not be the one with the biggest model. It will be the one that can identify which frictions are waste and which frictions are capital protection. It will automate typing, not judgment. Then it will model judgment before automating any part of it. It will treat the adjuster and underwriter as sources of institutional state, not merely cost centers. It will build audit before autonomy. It will classify vendors as data sources, not just service providers. It will tie claims, change, back into actuarial monitoring. It will make compliance a design constraint, not a post-launch review. And it will understand one brutal fact. A legacy insurer is not hard to transform because it has old software. It is hard to transform because the old software is where the institution hid decisions it could not simplify. Artificial intelligence can expose those decisions, but only after the insurer admits they are there.